We
Thank you.
hear so much about private credit these days and how big it is, how big it's gotten. Give us your sense of just how big it is right now and why it's gotten this big.
So when we talk about private credit, let me just zoom out quickly. We're talking about lending that is happening outside of the banking system, and that could be in corporate, real estate, infrastructure, consumer. I think a lot of the recent dialogue that folks are paying attention to is more along the opportunity in corporate lending. That's the most evolved and the most developed market, both here in the US and globally. In terms of sizing, no one quite knows just because a lot of this is in private hands, but order of magnitude, the private credit market for corporates in the US is about 1 trillion. Juxtapose that with C&I loans in the banking system, that's about 2 to 2.5 times that, and almost at parity in terms of size with the leveraged loan and high yield market.
So, what effect is the increased interest rates had on the private credit business? Obviously, it's affecting a lot of business right now. It's harder to get loans. If you can get them at all, they're more expensive.
Yeah, I think private credit has tended to outperform when rates are going up for two main reasons. Number one, the structure of the loans are short duration and floating rate, so they typically reprice every 30 to 90 days. So as rates are going up, the return is going up. That obviously in an environment where we're seeing a lot of volatility in the equity markets and valuations are challenged in the high grade markets, private credit is a place where people can actually go to benefit from rising rates. The flip side of that, obviously, is that as rates are going up, debt service becomes more challenging for leveraged borrowers. And so part of the conversation today is, as you're generating this excess return, at what point does the incremental interest rate challenge the companies? I would say as we sit here today, still really strong fundamental economic performance within the portfolios and not any signs of stress really making their way through as a result of the rate hike.
Mike, just pick up on a couple of things you said there, because I talked to one investor who said, there's no such thing as truly bulletproof in business, but these are close to it. And I guess it's because of the two things you mentioned, the short duration and also the fact you got floating rates. So if interest rates go up, you're protected.
Well, I hope that person you spoke to is an Ares investor already, but if they're not, I hope they're watching this show. Bulletproof is always something that you don't want to talk about in investing, but I would agree at this point in the cycle, private credit is a good place to be. Floating rate, as we said, short duration, but also senior secured. So if you think about where these exposures sit in a company's balance sheet or relative to the value of an asset, today most private credit loans are sitting in the top half of the capital structure, which means that there's institutional equity supporting those loans dollar for dollar. So there's a significant amount of equity valuation that would have to deteriorate before you begin to have a conversation about principal loss on private credit.
Mike, you mentioned Ares investors, and I wonder whether you're having, if anything, an easier time in getting investors these days because interest rates going up necessarily affect the value of equities just because of the discount rate. It makes it less attractive. Has private credit has become more attractive relative to equities as an alternative investment?
I think so. You know, in Ares manages close to $350 billion of assets globally, and we have funds that we offer across the alternative spectrum, including private equity. I would say as a general observation, investor appetite for pure play equity product is pretty muted right now, simply because, as you point out, valuations are challenged. And if you think about the drivers of return in that market, earnings growth is going to be muted, availability of leverage is difficult, cost of capital is high. So private credit does offer some pretty attractive relative value. And I think going into this part of the cycle, a lot of institutional and retail investors were underallocated to private credit. And so when they're grappling with the denominator effect from valuation deterioration in the public equity market and the high grade market, private equity is probably where you're feeling it the most. I think the private credit markets, people are still underallocated. So even though their alternative allocation may be lower, they're able to continue to allocate through that.
I've read also, Mike, that the size of the loans is going up. You can handle much larger loans than you did, say, 5, 10 years ago.
Absolutely right. I mean, one of the biggest drivers of the growth in private credit in the US and now globally was just bank consolidation and the increase in size in the public market. So if viewed through that lens, as banks have consolidated, it's more difficult for them to service smaller borrowers. And as the public debt and public equity markets have grown and moved towards larger borrowers as well, there's just a much greater white space for private credit and private equity, for that matter, to come in with larger capital solutions. So as that opportunity set has grown, and as folks like us have scaled capital, the average investment size has absolutely increased. Just to put that in perspective, when we started this business 20 plus years ago, a good sized borrower in this market was probably $25 million of EBITDA cash flow. And today, average cash flow in our portfolios is probably pushing 150 million.
How much of the growth of private credit has been because the banks have been more regulated? They have had to move back out of that space. And I guess the follow-on to that is, do you see a prospect of more regulation coming from Washington as private credit's gotten so big?
Yeah, I think that's a little bit of I don't want to say a false narrative, but a misunderstanding of what's been driving the growth of these markets. So bank consolidation is really the primary factor. So if you look at the evolution of private equity and private credit over the last 20 to 25 years, it really started with the consolidation of the middle market bank landscape into the big money center bank. So if you look today, there are 50% of the number of banks in the US than there were 20 years ago. As a result of that, what one may have expected, which was that all of this capacity would have, stayed in the system. The larger banks are now focused on larger borrowers and more liquid parts of the business. The regulatory overlay is less about regulation of the banks and really more about the regulatory capital framework and the profitability of this business on bank balance sheets. One thing that I think is misunderstood by most is that the banks are still very active participants in and around the private equity and private credit landscape. They're just attaching to the business in a different way, lending money to folks like Ares, supporting the buyout business through the syndication of loans. So they're still very, very active. I just think that they've moved away from being primary holders of middle market credit, which, I actually think makes sense.
And finally, Mike, where does the next leg of growth come for Ares and for private credit more generally? Is it taking more market share away from banks? Is it moving into new areas? I know Ares is in the United States, also to some extent in Europe, not in Asia.
Yeah, we're seeing what I would call horizontal and vertical growth. So geographically, we've been expanding into Europe over the last 15 years and now have a meaningful private credit business across the Eurozone. We are now meaningfully growing our business across the Asia-Pacific region. So there will be geographic expansion as these markets continue to evolve along a similar trajectory with a lot of the same trends that we saw in the U.S. There are also new markets that are opening as institutional investors are being more attracted to private credit and the private market ecosystem is growing. We're seeing opportunities in places like infrastructure lending, real estate credit, alternative credit. So I think we're still in the early stages of the development of these markets. And my expectation would be if we can continue to demonstrate durable performance through cycles, then the appetite for the asset class will continue to grow quite significantly.